even if I touch a meal. And do it through the pain, I don't need the pain. And life gon' get me down, but it won't break my will. Cause I've been chasing this so long, I can't give up. I won't give in, been through too much. I done prayed for the money, I done prayed for the fame. I done prayed that I will make a sacrifice and play this game. I done prayed that my life would never be the same. I done prayed that I will make it bring glory to my name.
Ladies and gentlemen, welcome to another episode of Uncle Strib. This is your boy, Uncle Strib. And before I get started, I'd like to thank you for all the support we're getting at IP Talks Podcast between Uncle Strib and Guardians 615. YouTube channel is growing, Spotify and the podcast version is also growing, so I appreciate you guys. And I also want to say that moving forward, Uncle Strib, we're going to try to drop an episode a week. And I'm now doing fan-submitted questions. So questions, topics, things of any type of topic to discuss. You can send them in. All you got to do is go to Instagram and follow IV Productions LLC. It's the letter I, letter V, Productions LLC. And just DM me a question and I'll throw it on the list. I got a running list. So I got topics that are going to be coming to you guys. And so getting straight into this episode, we have ETFs. This is somewhat a fan submitted question from a while ago. They wanted to know more about investing when I dropped in my investing video a few episodes ago. And I told them that I'm primarily an ETF investor. They want to know more on that. And so I told them I'd do a podcast on it. So we're working with ETFs today. Now, and I have my notes right here. So getting started, ETFs stands for Exchange Trade Fund. And all that basically means, to put simply, is that this ETF is a basket of companies. And with this basket of companies, it can be in any sector in the economy or the stock market. So the stock market is comprised of 11 different sectors: technology, healthcare, materials, consumer discretionary, energy. There's 11 different sectors that make up the economy. And then you could also have these baskets of companies in specific markets. So you could have real estate ETFs, you can have startup ETFs, high dividend ETFs. We'll get into what that is later. Sorry, it's a little toasty at the crib. So I got my towel. I might be sweating a little bit. But you can have ETFs in different markets, like I mentioned, startups, tech. You could have literally book companies that sell books. You can have ETFs in all kinds of markets, so it doesn't have to be in specific sectors. So, and you could also have ETFs that are in bonds, things like that. But I won't get into the nuances of those because this is just going to be kind of a quick overview with a medium level depth on what things are. So, generally there are two main types of ETFs. You have growth ETFs and you have dividend paying ETFs. Growth ETFs are just like growth stocks, to where the growth stock is a stock that appreciates in value over time a lot more significantly than a dividend ETF. So how it works is generally stocks that pay dividends. So a dividend is a certain percentage or a certain amount of money that a company pays you per stock for holding it. Since you're a shareholder, that means you own a piece of that company. You're a partial owner of that company. So if you own 500 shares of company A, and that company's dividends is $1 per share every quarter. Generally, most companies pay quarterly. Some pay once a year, some pay semi-annually, twice a year, some pay quarterly, and some pay monthly. But generally, we'll just use quarterly for my example, just because that's generally the most common is quarterly. So if you have 500 shares in company A, and they pay $1 per share every quarter, you're gonna get $500. Now, that is good. You're literally getting a check every quarter, but what that means is the money that's being paid out to all the shareholders is not going back into the company. Therefore, generally stocks that pay dividends don't have as much growth as companies that take that money and they put it invested back into the company. So there is some give and take. And then you can find companies or ETFs that kind of have a little bit of both. They don't have really great dividends and they don't have really great growth, but they have decent dividends and decent growth and things like that. But it's generally those two different types of ETFs. And occasionally you can get lucky with, like, they have ETFs that are high dividend yielding ETFs that invest in companies that are high dividend yielding. And because it's diversified, sometimes you can get good dividends as well as good growth, but you got to do your research. And so before getting to the pros and cons of ETFs, I do want to break it down a little further for you guys. The whole point of ETFs. So when the whole rule of thumb of investing is don't put all your eggs in one basket. You don't want to have all of your money tied into one company. You don't want to have all your money tied in one sector. For example, earlier this year, there was a banking financial crisis because Silicon Valley Bank went belly up, and it was, I believe, the 16th biggest bank in the country. So, I mean, it wasn't like a top 5 bank, but still, it was a very well-established bank and a lot of people had a lot of money tied up in it. So if you had all your money in the financial sector, early this year, you were probably a little worried because your portfolio probably dropped a significant amount. The overall market didn't do terrible. I mean, it did bad, but it didn't do as bad as you would think, because the big banks like JP Morgan and the big banks, the head honchos, they did fine. They were really fine. Some of them actually saw gains because people were leaving smaller banks and going to bigger banks. So the overall market as a whole, it did hurt, but it wasn't terrible. I wasn't worried. I do have money tied in the financial sector, but I have such a small amount in the financial sector, so I wasn't really too worried about it. But if you had money in smaller banks or like regional banks and smaller, then your portfolio was probably hurting a little bit. So there are things like that why you don't want to put all your money into one sector. And so ETFs is a very, very easy way to diversify, because you can literally, for example, you can invest in the entire stock market. So I invest in Vanguard ETFs. Vanguard is basically a market index, and they match market indexes, but that's not important. There's S&P 500, there's Vanguard, there's other companies that do markets that mirror certain indices. So the Vanguard has a technology market, and that technology index, that index mirrors the technology market. So there's VTI, which is the Vanguard Total Index or Total Stock Market Index, which means it literally has 3,800 something companies in that ETF, which means when you put $10 into that ETF, that $10 is divided up amongst the 3,800 and whatever companies in that ETF. So it's literally as diversified as you can possibly get. And it's easy to diversify with ETFs, obviously with the total ETFs. So to put even more simply, or simpler, I don't like how that sounds, but to simplify it some more, imagine the stock market is Walmart or a grocery store of your choosing. I know out here in Texas, San Antonio, H-E-B is a big one. But let's say the total stock market is Walmart, right? And let's say you really like candy and you want to invest into some companies in the candy aisle. But let's say you don't know which brands do well at Walmart in the candy aisle. So it's really, if you don't know what you're doing, you're really just gambling. Like, okay, let's do Hershey's, Sweet Tarts, Airheads, and Skittles. And you kind of just invest in those companies. If you don't know what you're doing or don't know what to look for, you're really just gambling, hoping that they do well. Or what you can do is you can get an ETF that you put money into that ETF and it represents you putting money into the entire candy aisle. Or if you want to get more specific, instead of certain sectors, you can get specific with markets. You can get an ETF that represents chocolate, an ETF that represents taffy, ETFs that represent gummies, things like that. Then you can still be diversified in an industry or market or sector that you want to, without the need to kind of understand the nuances of each individual company, right? And so that's how ETFs work. You can invest in the candy aisle, you can invest in the bread aisle, you can invest in the, juice aisle. Each aisle represents a sector, or each aisle can represent a market. In the ETF, you can do the entire market or that entire aisle. Or if you only wanted to invest in gluten-free breads at Walmart, then you can get an ETF that represents gluten-free breads companies and things like that. And of course, the VTI, or the total stock market, would be just investing in the entire Walmart. You don't know which aisles to which. If you don't know which aisles to invest in and what not to do, you could just, all right, I'm going to put money into this ETF that represents the entire Walmart. right? Just like the VTI, it represents the entire stock market. So if one sector or one aisle does bad, there might be another aisle that's doing well that can counteract the aisle that's doing bad. It can counteract that and things like that. And so like the S&P 500, the Vanguard has the S&P 500, which is basically the top 500 companies in the stock market. You have it equipped to, for the analogy I was using, it's the same as the top 500 selling items in Walmart. You invest in that. So that's essentially how ETFs work if you want to think of it, in layman's terms. Now, let's get into the pros and cons of ETFs. So first, pros, it's diverse. Like I mentioned before, I'm going to pull up my Robinhood. So I invest in Robinhood, or I use Robinhood to invest my money. And if we go to VTI, it's diversified. You have 3,861 different companies in this one ETF. You put $5 in or $10 in, $100 in, and it gets put into the ETF, and that ETF manages the money to where you basically own a piece of 3,861 companies. And obviously it's not equally distributed, but I'm going to go into that later, into like what to look for when you're looking at ETFs to invest in. So more pros are low maintenance. Again, all you're doing is you're putting the money in, and and Vanguard that's running that specific, for the index I'm using Vanguard. So Vanguard is running or managing that ETF. So I don't have to go in and adjust what percentage of what sector I want to do. I don't have to go in and and take out a little bit of Apple and put more into ExxonMobil. I don't have to do all that. That's done for me. I just put the money in there, and I essentially just reap the benefits. It's very, very, very low maintenance. If nothing else, you literally could just, like, I only have money invested into one individual company. The rest are all to ETFs. You could literally build a portfolio that does great returns and pays dividends off of straight ETFs, and it's generally safer because it's diversified. So those are two pros. Now, cons, again, you can't individually invest in the companies. Now, if you're using Robinhood, if you want to invest in, for example, I invest in Ford. It's the only individual company I have. If you want to invest in Ford, you can have money in ETF, have money in Ford, have money in Apple, have money in Tesla. So you can still diversify your portfolio with a mix of ETFs and individual companies, but the money you put in that ETF, you can't control how that money gets used within the ETF. So it's a little less hands-on. It's a double-edged sword. Some people want to be very, very hands-on, and especially the people that are really advanced and know what they're doing, they might not want an ETF, because ETFs do have expense ratios, which is basically the amount of money that gets used on the profits to pay Vanguard or to pay the people that are actually managing the index. So there is some money that's kind of, you don't see that being taken out. It's off the top. So you only see what you're supposed to get. But it does eat into the profits because there is an expense ratio. So if, some people that are really advanced and can create their own ETF, essentially, they can be all hands-on, and when something's outperforming the rest, you can shave off the top, or you can you can sell into the upspring, or you can sell into the gains, and then you can buy in to the losses on the lower end. But we're talking really advanced move. But you don't have to do all that with an ETF, but that's one thing you can't do if that's something you want to get into, or eventually get to the point you learn, or get to the point that you want to learn that. But again, the way it's set up is actually fairly easy, to where if you have your money in a VTI or in a ETF, and the ETF only has like 60 companies in it, you could probably just read the ETF stats, see what percent is the breakdown, and see what companies are in it, and you could probably just do it yourself, so you can bypass the expense ratio. That's if you want to do that and be more hands-on and a little more advanced. And the second con is it's not as precise, or it's not as precise in terms of the individual, and you can't outperform the market. What that means is the money I put in VTI, which is the total stock market, I can't outperform the total stock market with the money I have in that ETF. The money I have into the technology index, which is the most, sidebar, the technology industry or sector has been the most lucrative sector in the past 50 years. The gains on the technology sector, I can actually find those numbers for you live right now. In the past 5 years, it's up 142%. So you best believe I'm gonna have money in there. But technology's been the most lucrative sector in the economy. But the money you put into the Vanguard Technology ETF, you're not gonna be able to outperform the technology index. You're not gonna be able to outperform that sector. So investing in the individual companies, you could outperform the market if you only choose winning companies within the market. For example, let's use technology. I'm gonna probably use technology just because it's easy. But let's say you choose a technology sector, right? The Vanguard, the VGT, the Vanguard Technology Index, it has, I'll give it these numbers for you live real quick. It has, if it'll show me, I might be tripping. It has 325 companies in it, 325 holdings. And it also tells you, but I'm gonna get into breaking down these numbers for you a little later. It has 325 holdings. Out of 325 companies, some are gonna do well, some are gonna be positive, some are gonna be positive net gains, some are gonna be negative. If you have it invested in all of it, you're not gonna be able to outperform the total stock market if you're buying the total stock market. But let's say you're gonna somebody that wants to be very individual and do it hands-on, and let's say you pick the companies that are only doing positive let's say for 1 year, you pick these companies and these companies are green the entire year. You don't have a single company that's down, that you can outperform the sector. Even though you're in that sector, you can still outperform it because you don't have any companies going red. Now, that's very, very hard to do. It's very advanced. You have to really know how to break down balance sheets and read the stats on companies. It's possible, but for me personally, I'd rather just invest in the ETF. And because, again, I know what to look for, I'm going to break that down a little later. I like to be a lot more hands-off. I don't want it to turn, for me, it's all about long-term investing. I don't want to have to turn into a day trading where I got to sit at my computer and sit there and sell and buy and manage my own handmade ETF. That's not what I'm investing for. I'm investing for passive income, hands-off. I put the money in every paycheck or every month or whatever. And if I don't open in 2 months and I open the app up, it's up 10% kind of thing. That's where I'm trying to get. But those are some cons or limitations to having ETFs. Now, what to look for in an ETF? This is my favorite part because it's really not that hard when it comes to what to look for ETF. So again, let's go to Vanguard Technology, which is the Vanguard Information Technology ETF, VGT, if you guys want to Google that ticker to see what's up. Now, the first thing I look for is number of holdings. So for example, the Vanguard Technology ETF has, like I said earlier, 325 holdings, 325 different companies. So you want to look for diversified portfolios. If you see an ETF that only has 20 companies in it, it might not be for me personally, it's a red flag. For you, you might want to do a little more research. See, those 20 companies, are they big dogs? Are they big companies in the economy? Are they that's when you kind of want to get into what those 20 companies are, because 20, that's not that diversified, especially if it's 20 companies in the same sector. But I look for that. So Vanguard 325, that's fairly diversified. Again, VTI, the Vanguard Total Stock Market, 3,861 different companies. I mean, you talking about as diverse as you're going to get. Second, you want to look for sector percentage. So obviously for VGT, the technology, Vanguard Technology, obviously that's specifically the technology sector. So sector percentage, it's 99.4% in the technology sector. Obviously, because it's specifically technology sector. But if we go to one of these ones that I have the Schwab US Dividend Equity ETF. It's SCHD. It's not in a sector. It just invests in high dividend companies. So for this one, if you go to the breakdown, it's 104 different companies, and it's 18% industrials, 15% finance, 13% consumer defensive, 15% healthcare. So it's a little more evenly distributed between different sectors. And again, this is like a market ETF. It's not a sector, obviously, because the highest sector is industrials at 18%. There's a 15%, 15, 12, 9, 4, 8, 2, 13. So it's a little more choppy between different sectors, but that's what you want to look at if you're looking at non-sector representative ETFs. Because obviously VGT is going to be almost 100% in technology. The next thing you want to look at is top 10 holdings. So if we go to the VGT top 10 holdings, it tells you the top 10 companies. Apple's 23% of the index. Microsoft's 20%. Broadcom 3%. Cisco Systems 1.8%. Adobe 1.9%. So it told you the top 10 holdings and the percentage of that sector in those top 10 holdings. So obviously Apple's and Microsoft are the two big dogs. You're talking 23% and 20%. So literally of the technology sector, Apple and Microsoft combined accounts for 43% of the entire technology sector. So that's some things you want to look for when you break it down. Next is price to earning ratio. Ladies and gentlemen, let's take a quick break from the show. And I want you to do 3 things for me. Real easy, real simple. 1, wherever you're listening to this podcast or watching, subscribe. Whether it's YouTube, Spotify, Apple Podcasts, Google Podcasts, whatever it is, subscribe to this channel so you can stay up to date with the podcast we have dropping for you for Uncle Strib and Guardians of the 615. Second thing I want you to do is get on Instagram. I know you have an Instagram. If you don't have an Instagram, make an Instagram and follow IV Productions LLC. It used to be IV Talks Podcast. It's now been changed to the letter I, the letter V, Productions with the S, LLC, IV Productions LLC. Go to the Instagram, follow us on Instagram. Another easy way to stay updated with not only the podcast we're dropping for both Uncle Strib and Guardians 615, but as well as the new merch we do have dropping, and we're going to be getting into some cash giveaways here pretty soon. So follow those to stay up to date for cash giveaways for sure. And the last thing is, when you go on to Instagram and follow IV Productions LLC, click the link in the bio. We have 2 websites. We have a professional website where you can check out our bio. You can check out all the platforms that IV Productions is producing, including the Guardians 615 and Uncle Strib. And the other link that is on there is going to be our merch website. We officially have merch dropping, and we just have it available for you guys if you want to support. Rock the gear, rock the wear, however you want to do it. But we really appreciate you guys, and we'll have merch coming to you guys for great affordable prices. Just get on there, check it out. We got t-shirts, we got crop tops, we got hoodies, jackets, all kind of things. But appreciate you guys for listening, and back to the show. Next thing to look for is going to be your price to earnings ratio. To put simply, your price to earnings ratio is essentially it's a metric used to tell you how well of a price a stock is. So the average price to earning ratio is anywhere from 20 to 25. The lower the P to E ratio, the better the buy is. And it's basically, if you look at a P to E ratio, I generally just go with 25. If it's under 25, it's good. If it's close to 25, it's good. If it's under, it's pretty good. Anything less than 20, it's a pretty good P to E. And it's basically, you're paying less for every dollar of that stock. To put simply, I don't want to get into the nuances how they calculate that and what that means, but just know the lower the P to E ratio is on that stock or ETF, the better investment it potentially could be. Now, again, this is with looking at all the things that I have talked about earlier, what to look at. If you look at all these things together, you got a good, if we look at how the number of holdings, the sector percentage, top 10 holdings, you look at those companies, and then you look at the P to E ratio of all of that, if all of those things are in alignment together in terms of looking at like green flags that are red flags, is probably going to be a good indicator. So for example, I have my Robinhood pulled up, and we have Ford Motors, which again, I talked earlier about how I'm heavily invested into Ford Motors. If we scroll down, we see that Ford has a price earning ratio of 1986, which is well under 25. So that means that it's a solid investment because you're paying less for every dollar versus a company or ETF that has a price P to E ratio of like 30 or 25. Now, just because it has a high P to E ratio doesn't necessarily mean it's a bad investment, but you do have to look at other things in terms of if it's a dividend, if it's growth, how much cash flow. Again, I don't want to get in too much detail with that, but just take into account that with everything else I mentioned. One last thing I did not put in my notes, that is another thing to look for, and I kind of mentioned earlier, anytime you look at a stock. So example, let's go to the Vanguard the Vanguard Technology ETF that represents the entire technology sector. Anytime you're looking at a ticker or you're looking at the graph of how that stock or ETF has performed over a certain amount of time, if you go on Google or Yahoo Finance, wherever you go to look up that ticker, obviously if you use Google, it's pretty simple. Google, it'll show you right there. Always go to the maximum amount of time that it will let you see. I think on Google, it might go up to 15 years, maybe 20. Sometimes it says max, and I believe it shows the entirety since that stock or ETF has been in existence. It'll show you the overall net gain it has, percentage and dollar amount. So here on Robinhood, I can go up to 5 years. So Vanguard Technology ETF, if we go over the past 5 years, it's up 142%. That's what things you want to look at. So with that pattern, if we do 142 to round divided by 5, it's gone up an average of 28% per year in the past 5 years, which is ridiculous. The average amount of return you make in the stock market is 6%. So I would suggest this, but technically, if you invested all your money into the technology sector, your money would have increased 28% every year for the past 5 years. Now, again, we still want to stay diversified, but just for an example, that's the amount of return. That's what you want to look for in an ETF. And so that also means that with that pattern, we could assume that from now, let's say you invested now, let's say $1,000. Now it would be fair to assume that in another 5 years, you would see something similar to another 142 or somewhere or anywhere around 28% a year, because it's kept that trend. Now, obviously, if we look back and you go back 10 years, that number might be different. If you go on Google, I do believe it goes higher than 5 years, but on Robinhood, what I use, it just shows 5 years. But again, that's what you look for. All in all, regardless, it is a very net gain positive ETF, which is what you want to look for. Again, we can go to VTI, the Vanguard Total Stock Market Index. Over the past 5 years, it's gone up 56% in the past 5 years. So I want to get a more precise number. We go 56 divided by. So it's gone up about 11.2% a year. Again, you're outperforming the. We gotta log back in. But again, that's great returns, because the average return in the entire stock market is usually 7% a year. Now, those are all the things I want to look for. Oh, and again, the opposite of that, if you're looking and over the past 5 or 10 years, it's negative percentage, it's a negative gain, or it's a loss, that's probably not a good investment. Honestly, that's probably the number one area. The first thing I would look at is you look at an ETF or company. If it is over the past 10 years, trended downward over 10 years, I'm not touching it. Me personally, I'm not touching it. That's probably a bad investment, because that means over the past 10 years, it's done nothing but gone down. You've lost money every year over 10 years. That's just not a good investment. So just that initial look alone will tell you if it's worth investing or not, just from that initial look. Then you can go, if it is trending up, okay, it's up 10% in the past 4 or 5 years. It's not a lot, but then you can get into, okay, what's the PDE ratio? Is it good? If it's, let's say it's 18, the PDE ratio is 18, and it's a dividend paying stock, then you could infer that, okay, this ETF is not a growth ETF, so it has gone up, but it's only gone up 10% in 5 years, so you're only going up 2% a year, but it's paying you dividends, and your bang for your buck is low or good because it's a low PDE ratio. That's how you can kind of get an initial look, do a little bit more digging, and then you can decide whether or not that's a good investment for you. Based on that example I gave, I would invest in that, because over a period of 10 years, I'm going to be positive in appreciation. On top of that, every quarter I'm getting a paycheck, and I'm getting good bang for my buck, or I'm getting a good price for that stock because the PDE ratio is low. That's how you would kind of break that down. Now, the last thing I want to go into is best strategy. And for this section, I labeled best strategy. This is just what has worked for me since I started investing back in 2014. What I do that has worked for me is, in my Robinhood portfolio, I like to call it a stabilizer. You need a stabilizer, something that you put in that doesn't really move much. Some people put that into gold or silver because they're pretty stable. They're not really going up, they're not really going down. They're pretty much staying somewhat the same for the most part. But what I do is Robinhood, they actually give you, they kind of treating it like a savings account now. When you put money in, you get 4.65% on your money that's just sitting there, the uninvested cash, which means I have a certain amount in my portfolio that is straight cash, that's not invested into anything. So if markets are being very volatile, I at least have a certain percent of my portfolio that's just stabilizing my portfolio. It's not going down. It's not going up at the moment because it doesn't pay your interest till the end of every month. But right now I'm making like 5 or 6 cents a day on just the money that's not invested. So it's worst case scenario, I just make, I don't know, 30 cents a month or whatever that math is. But it's not going down. So that's a good stabilizer because that cash is sitting there. It's securing now with this. Obviously, before they started the 4.65% on your uninvested money, before that, it was just sitting there, but it's at least stabilizing your portfolio. So you got a stabilizer, but with now the 4.65, it's actually even better than stabilizer because it's never that five. Let's say you have 500. That 500 is never dipping down because it's not invested. But at the end of the month, that 500 grows. So it's actually even better than stabilizer. But you're not making that much interest per month. But that's the stabilizer part. Next is I invest in a broad ETF. So first we got a stabilizer, uninvested cash that kind of just stabilizes your portfolio. So if let's say God forbid, every sector goes to zero, I don't lose everything. I'm still hurt. I'm gonna lose the majority of it because it is a smaller percentage. It's not the majority. But worst case scenario, I won't lose everything. I'll still have something to fall back on. Second, a broad ETF. So the S&P 500 or the VTI that I've been talking about, the total stock market. I have a very broad ETF that I'm invested in. I think it's good to have a stabilizer, and then however much you want to invest in each part is up to you. I have a small percent in the cash. I have a decent amount in the broad ETF, but you can break it up however works for you. But as long as you have those different things, that's at least what's worked for me. Stabilizer cash. I got a broad ETF. I got the VTI. And then I have sector/market ETFs. So I have the technology sector ETF, and then I also have the Schwab US dividend equity. I also have the JP Morgan equity premium income. So it's invested in companies that are gonna pay high dividends for passive income type companies. And then lastly, high dividend ETFs. So like I said, the JP Morgan and the US dividend are my high dividend ETFs. I have the technology ETF, which is a sector ETF, and then I do have a medium to high growth with dividend. That's this sector market. So the other market one is the S&P 500 high dividend, low volatility. So these are specifically companies that pay high dividends, but they're not very volatile. So they're not very up and down. They're pretty stable. So they're not growth. I won't say they're not growth because over the past 5 years, it's only gone up 1.8%. So it's not a growth ETF. So, but it's positive at the end of the day. It's still up, but those dividends are starting to pay out. So I have my portfolio set up to where once I get a good chunk of money in there, I'm focused on more of that passive income every quarter, getting a paycheck. Actually, I believe the JP Morgan, either JP Morgan or the Schwab US, one of those pays monthly. So at the end of each month, they cut you a check. So I have mine set up for more passive income type of investments, long-term passive income. So I'm hoping 30, 40 years down the road, I'm seeing like fat checks every month and every quarter just from the high dividend paying stocks. And then I still have those broad ETFs that are focused on just the growth over time. So I have a combination of a stabilizer that will grow as I add more cash. I'll make more money per day, more than 6 cents. And on top of that, I will have the broad ETF, which will give me the long-term growth that's going to appreciate my portfolio over time. And then the other ones, I have the high dividends, which are paying me money as I go now until, in perpetuity. And then lastly, I do have one individual stock, and that's the Ford. And the Ford has been a little bit of both in terms of growth and dividends. The dividends on Ford has been really, really well. I know during COVID, there was a couple years. So the thing about dividends, some stocks, individual companies, that they can stop dividends. So just because they're paying dividends doesn't mean they're always going to pay dividends. Sometimes they might make a decision to forego dividends for a year, forego for this quarter, or just completely stop dividends. Some companies will start paying dividends. So you have to keep up. You might have to keep up with those companies and kind of what they're doing. Generally, if you are a shareholder, they actually will mail you things when they make decisions that will affect your portfolio, and they'll have shareholders actually vote on those things. So it's pretty cool getting mail from Ford Motors saying that they're doing this, and they want me to vote and send it in. So I actually feel like a legit owner, which I am a legit owner, but I feel like, it's just a weird feeling that Ford's having me vote because I'm actually a partial owner of Ford Motors. But anyway, over the past 5 years, Ford has gone up 30%, which is pretty good, but their dividends actually pay pretty well. I believe the last payment of dividends, it was, let me look it up so I can give you guys accurate numbers real quick. They're paying 15 cents a share. They're paying 15 cents a share, but it only costs $14 per share. So you could really stack up, and that's why their PDE ratio is 19, because it's not an expensive stock. And 15 cents a share doesn't sound like much, but that's actually pretty good for in general, in terms of the price for the stock. So at $14 a pop, and you can 15 cents a share. That's generally how the PDE ratio is determined. Because if Ford was $100 per share and it was only paying you 10 cents a share, that wouldn't be a very good PDE ratio in terms of dividends. Now, if it was growing like a growth stock, then that's when things you might have to consider. But Ford has been a good balance, and it's been a good one for me. But thank you guys for listening. If you made it this far, I appreciate it. Again, I will be doing topics that are fan submitted. I'm going to be dropping these once a week. And so if you guys want to send in any topics or suggestions or hypotheticals or would you rather, any of those, I'm accepting all topics or whatever. Just go to Instagram, follow the Instagram IV Productions LLC, the letter I, the letter V, Productions with an S, LLC. Follow, go ahead, DM me, and I will throw it on the list, and I'll get to it whenever I get to it, because the list is actually quite thick. But this has been your boy Uncle Strib. We'll catch you guys next time.
I'm gonna chase my dreams.